Mark Mobius of Mobius Capital Partners. He's joining us right now on the show. Mark, thanks very much for taking out the time and speaking with us. Global market sentiment has been completely dampened by the spread of coronavirus, and not just the fact that the Chinese mainland is starting to see some bit of a respite in terms of the number of new cases, but the rest of the globe is pitching in with its own volatility and its own spike in number of cases. Do you feel that now the pressure builds on the equity markets in a bigger fashion because we hadn't yet paid heed to the coronavirus up until now?
Yes, I think the pressure will continue, and I think the main reason for that is that the unusual in this case is because it stems from China. With this virus beginning in China and then spreading, it puts a big pressure on the supply chain for people around the world. As you know, for example, if you take pharmaceuticals, something like 80% of all the raw materials, pharmaceuticals globally, come from China. So if that supply chain is interrupted, that affects companies all over the world. So I think as we go forward, if this continues, then the impact will be much greater than people think.
For market watchers, the recovery may get pushed to the second half of the year. That's when, we are already seeing a lot of central banks and the governments trying to ensure that there is stimulus in the system. But that will probably play up in the second half of the year. In light of that, if there is a recovery that is to happen, do you feel it will linger and it will take its time? Or do you feel that the recovery could be at a faster clip?
Well, of course, if, for example, let's say, President Trump decides to lower tax rates again or provide some other assistance to businesses, that could ameliorate the situation, help the situation a lot. But it still remains the fact that the supply chain interruption has worldwide consequences. And that, of course, will be felt in the earnings that we see coming down next year.
So we're talking about earnings coming down, and a pertinent point that was made earlier in the morning by James Sullivan from JP Morgan. He says that to argue in favor of a speedy recovery would be futile because multiples are extremely elevated and earnings are questionable. So in light of that, if you put both these factors together, you cannot argue for a recovery anytime soon.
Well, that's right. That's the reason why you have a combination of situations, particularly in the U.S., where the market has done so well for so long. A correction of this magnitude has big impacts. And, of course, as I said, with the supply chain interruption, the situation could spread globally.
Mark, hi. In light of all the factors that we've been discussing, of course, around coronavirus, and this week is touted to be the worst week for global equities since 2008 now. I want to focus a bit on India. Even when the markets were moving higher, last year's rally was, liquidity driven. At that point of time, FI money was coming into India, even when people were saying that it's one of the most expensive markets in emerging market space. With the recent correction now, how do you approach the Indian markets if and when the concerns around coronavirus start to ease?
Well, I think India looks pretty good. And if you consider just the fact that so many Indians own gold, and with gold prices doing well in this kind of environment, that means India's in a pretty good position. Now, going forward, with the visit by Trump, I think relations between India and the U.S. should get better, and that would provide additional stimulus to the Indian economy.
Do you then feel money coming back? Because last few days selling could also be ETF related, which a lot of market participants have been highlighting. Just in last 4 sessions, by the way, FIs have sold over $1 billion in India, which is pretty much a big number, just in 4 trading sessions. So do you see foreign money coming back into India once these, worries around coronavirus start to ease?
Yes, I do. And simply because a lot of companies around the world are beginning to realize that they're very vulnerable, depending only on China for their supply chain. And therefore, India will be in a good position to pick up some of that business. The question now is how fast the Indian government will respond and facilitate this kind of move by the multinationals.
Mark, you touched upon gold as well. Of course, back home in India, gold prices are at all-time high. And situations like these, investors tend to flock towards safe havens like gold. If I were to ask you, with the recent correction that we've already seen for equities, what's looking more attractive? Would you advise to park money into safe havens like gold, or it's good valuations now for equities?
Well, as you know, it's been a year or two now that I've been recommending that people have at least 10% of their assets in physical gold. I'm not recommending that you rush into gold at this stage with prices at a high, but any correction would provide an opportunity to buy more.
Mr. Mobius, I just wondering if somebody is looking to allocate fresh money right now, would buying at the current levels be a prudent call, or because of the fact that this is a bit of an imponderable as to what extent and the pace at which it could do damage to economy because people will not be mobile enough and moving out enough, it's prudent to just hang on for the time being and wait for the dust to settle? Better to buy once the print is in place as opposed to trying to catch a falling knife. What would be your suggestion?
I think that's reasonable advice. But the point is, it's very, very difficult to time the market, as you know. Markets have their own behavior and very difficult to predict. But I think it's very important for people to focus on companies that are paying dividends. So in other words, if you have a company that's come down a lot and is still paying solid dividends, then it's a good idea to buy. Of course, you can do average cost buying on the way down, but no one knows when the bottom will reach. But if the company is paying dividends, it makes a lot of sense to buy such companies.
Mr. Mobius, the other thing is when I look at, for example, when I looked at my own website and just looking at, or the Bloomberg website and looking at stimulus, almost all of the Asian markets or Asian economies are looking at giving some form of the other of stimulus. Do you reckon such a combined stimulus would be enough to negate any kind of fallout due to work disruption caused by coronavirus?
Of course, it'll help. There's no question about that. But the fact remains that you can do all kinds of stimulus, but if the earnings are not coming in by the companies, then it's not going to have that much effect.
It's true. One small question really, and that is the kind of view that people might have towards individual economies. And I've heard a lot of opinion talk about how because of the crude price fall and the inward-looking economy that India is, the damage might not be that bad on India, with the presumption, of course, that virus doesn't make its advent into India. Thus far, we've been saved out here. Do you think people will distinguish between make a distinguishing factor like this, or all EMs or all Asian markets will be painted with the same brush for the time being?
No, of course, people will differentiate. And, of course, the good news is with the oil price decline, that helps India. It helps other oil-importing countries. But the bottom line is that as India and other countries move away from fossil fuels generally into solar and wind, the future for oil, I think, is not very bright to begin with. So this all augurs very well for India.
Mr. Mobius, do you feel that in light of what you just spoke about with regards to the stimulus coming in from various governments, that could pose its own challenges? Because while we might be seeing the implications of coronavirus right now, this is pretty time-bound. So once we see this reversing course, on top of that, an overstimulated economy, global economy, will have its own challenges to face because earnings will still not be able to pick up towards the fag end of the second half. And inflation would rear its ugly head because of the overstimulated economy. So in such a situation, what could one do?
So I don't worry too much about inflation. Then if you look at just the oil prices, which have a lot to do with inflation, you realize that inflation is not going to rear its ugly head anytime soon. The general trend, by the way, is deflation, not inflation. So I think the worry about inflation is not a worry that we have to really concern ourselves with. The real worry, as I mentioned, is supply chain interruption and the impact it has on earnings. That's really what the impact will be. But as I said, if you're buying companies that have paid dividends on a steady basis and continue to pay dividends, maybe because of the supply disruption a little less than previously, then you're in pretty safe ground.
Just one last question, Mr. Mobius. In your assessment, of course, we've not received many reports highlighting what sort of an impact will coronavirus have on the global economic growth now. Any assessment from your side?
Yeah, I would say that a 0.5% change is warranted. In other words, the U.S. maybe will have maybe a 0.5% change from what the projected growth is going to be, and I think that's true for the world economy as well.
Okay. Mr. Mobius, we leave it on that note. Appreciate you joining us today and taking us through your thoughts on what's happening with the world equities and whether there can be any sort of recovery from these levels or not.